So today, the almighty Google recommended this article to me, the 5 stocks to buy with dividend yielding more than 6%. So a list of 5 high dividend stocks. I went through the list pretty quickly, and I realized that they're all but one oil and gas related. Most of them tend to be kind of pipeline companies. And the plan for this video was to go through all 5 of these companies and see if they're good investments. The thing is, I quickly realized that they're all yield traps, at least in my opinion. So that's why the updated plan for this video is to just take one of them as an example, this first one, Enbridge. I'm going to go through both the micro and the macro factors, which to me, I'm going to define that as the micro being the individual company's financials and their current situation, and the macro is the market and the environment that the company is operating in. And then at the end of the video, I'm going to show you guys how to get a high dividend yield that's not a trap. Okay, so let's use Enbridge for this example. So let's read what they have to say about it. With a 6.8% dividend yield, Canadian pipeline stock Enbridge offers an attractive opportunity for dividend investors. The company transports and stores oil, liquids, and natural gas. Its liquid operations account for a little more than half of its earnings, while natural gas and other midstream operations make up its remaining earnings. All right, so it's a pipeline, natural gas, oil-related company. So let's come over to Seeking Alpha and begin looking at some of the data. Now, the first thing I want to do is look at the price history because there's an inverse relationship between the price of a stock and the dividend yield. So what that means is the dividend yield could be very high simply because the share price is going down, meaning that the company isn't great and people are selling out of it, making it a very basic yield trap. And the math behind this is very simple. If a company pays $1 per share in dividends, but then that share falls 50% in price, the yield is now double as high. So if we look at the price history of this company in the last 5 years, it's not great. It does have a downward trend. It's down 5% over 5 years, so not a great investment, but it's not enough to account for the high dividend yield in and of itself. So now let's move on to the finances of the company to see what kind of situation it's in. Total revenues is one of the best metrics to look at, and it's not going up. It's not necessarily decreasing. It's just moving sideways, much like the price of the stock, which is usually actually a good thing when the revenues and the price of a stock align with each other. But of course, the main thing with this company is that high dividend yield. So if we come over and take a look at that, it has a dividend yield of 6.87%. But the payout ratio, this is the first big red flag, is 129%. And the payout ratio is kind of the health bar of a dividend. You want it to be as low as possible because the payout ratio is simply how much of a company's net income they're paying out in dividends. So ideally, you want this to be as low as possible and to be falling over time as the company makes more and more revenue. In this case, it's over 100%, which means they're paying 130% of their net income out in dividends. And the only physically possible way of doing that is to take out debt and pay out a dividend using a loan, which is not a sustainable and healthy situation to be in. By the way, I apologize if you hear the thunder in the background. It has been thundering every single day this month. And to confirm this, we can come over to the cash flow section of the finances of this company and begin to poke around. So I want to draw your attention to the cash flow from financing activities. And this row is the one I want to begin on. So this is the common and preferred stock dividends paid. So this is just how much they paid out in dividends. And I want to focus on the current year, or the last one reported, December 2020. And they paid out $5.5 billion in dividends. Now, the next thing I want to look at is the total debt issued. And once again, I want to focus on the last reporting period. And they issued $5.5 billion in new debt. But they also repaid some debt. So that's being shown in this row. And during that same time, they paid back $3.5 billion in debt, leaving $2 billion unaccounted for. And if we come up to the net income, this is where that dividend is paid from. They had net income of $2.6 billion. So the company paid out $5.5 billion to shareholders in the form of dividends. They have $2 billion in unpaid back debt for that same time period, and their net income is $2.6 billion. So this confirms that the company used all of their net income as well as additional debt to pay out that total $5.5 billion in dividend payments. So not a great situation. But dividends aside, the company doesn't look awful in terms of revenue and net income. It is profitable, and they are making a decent amount of money. But now I want to switch from the micro, the individual company, to the macro and the environment that this company is operating in. So I first want to read this description of the company. So Enbridge is a multinational pipeline company headquartered in Calgary, Alberta. It's focused on the transportation of crude oil and natural gas, primarily in North America. Enbridge's expansive pipeline system is the longest in North America, with over 5,000 kilometers of pipelines in Canada and the United States. So the company is very dependent on fossil fuels, mostly in North America. So now let's try to get a better understanding of the trends in the industry. And to do that, we have to begin to look at some data. So this is the daily demand for crude oil worldwide from 2006 into 2026, so some future projections. And this data isn't that damning. We can see that into the future, the demand for oil is going to continue to rise a little bit. But that's about where the good news ends for this industry, because the US Energy Information Administration projects that the share of renewables in the US electricity generation mix will increase from 21% in 2020 to 42% in 2050. Wind and solar generation are responsible for most of that growth. So this is the competition that oil faces, and thus this industry and this company is going to have to contend with. But yet there is a lot more info to look at. So this is a report from the United Nations, pretty reputable source. And these are the countries dedicated to having net zero carbon emissions. By looking at this map, we can see that all the major countries, including North America, are on board with this pact of reducing their emissions. We can also come down to this, which is pretty damning. 45% of emissions reductions needed by 2030 to keep warming to no more than 1.5 degrees Celsius. So there's an active push by the UN and all these countries to have less emissions, which means having less dependence on fossil fuels, which is the industry that this company operates within. So that's a major headwind that this company is facing. I mean, the industry is literally being phased out by all the global governments of the world. California will phase out gasoline-powered cars and drastically reduce demand for fossil fuel in California's fight against climate change. This is something a lot of states and even countries are doing. They're introducing a ban on fossil fuel powered cars and vehicles by a certain date. I believe California is 2035. They're going to make it illegal to sell gas powered cars, which of course is going to drastically impact the demand for oil. And in case all that wasn't bad enough, how many years of oil is left in the world? 47 years. So all that together, the micro, the individual finances of this company with the payout ratio being over 100%, and the macro of all the governments in the world working towards eliminating fossil fuels, that's why it's my opinion that all the companies related to pipeline and gas are yield traps, because the industry is shrinking and these companies will suffer, and the only reason why they have high dividend yields to begin with is to attract investors, because there's no other reason to invest in these companies. They have zero future. So yeah, I don't like any of these companies, but luckily there's another way to get a high dividend yield without buying a value trap. If we come over to my portfolio, this is the way that I achieve a high yield in what I believe to be a much safer and sustainable way, and it's through dividend ETFs that use a covered call strategy. So JEPI is a great example of this. It has a 7.5% dividend yield, and it's way more diversified. It has about 100 holdings in it. 80% of the portfolio is blue chip, large cap, dividend paying companies, and then the other 20% is called ELNs. It's a financial derivative that kind of takes stocks, wraps them up into bonds, and they can generate an interest rate off of that. It provides some downside protection, and ultimately it's how you get a higher dividend yield. And this is the way I like to go about chasing yield, so to speak. But my next video is actually going to be about my top 3 high dividend ETFs. So definitely subscribe to the channel if you want to see that. It's going to be a follow-up to my last video, which was my top 3 favorite individual stocks. So if you guys want to see that, subscribe to the channel. I hope you enjoyed the video. If you're still watching, give it a like, subscribe to the channel, and I will see you in the next video.